I'm just going to stick to the business provisions, and I will just begin by saying that the process under which this legislation was enacted was unprecedented, and if anybody wants to talk about that, I'm happy to do so. But one of the reasons that the Act has many of the issues and problems that it has is because of the way it came into existence, and I think that's just worth noting. We began with a reduction in the corporate tax rate. This was a bipartisan consensus that the corporate tax rate, which before this legislation was 35% and was among the highest in the developed world, needed to come down. President Obama said 28%. Chuck Schumer now says 25%. Dave Camp, who was then chairman of the Ways and Means Committee, a Republican, said 25%. Donald Trump said 15%, so we ended up at 21%, which is actually not outside the realm of normal compromise, given the differing views. And so that's, I think, both an improvement and not a surprise, even though the bill was enacted with only Republican votes. I think the Democrats, had they been involved in the process, would have supported a lower rate, but now they can complain about the fact that the Republicans have enacted a lower rate. I guess I should say that just to give you one quick view is that, in my view, if what you are concerned about is that lowering the corporate rate benefits the owners of corporate stock, and you're worried about the distributional consequences of that, the way to respond, both economically and substantively otherwise, is to raise the shareholder rate, not to raise the corporate rate back up. On the international front, the system that had been in place since early in the 20th century, which was to allow subsidiaries of U.S. corporations to defer any U.S. tax until they repatriated their earnings, and then to pay tax on the difference between the U.S. rate and the foreign rate, was broken. It had resulted in $2.5 to $3 trillion of assets being held abroad. The only way that U.S. companies could reinvest that money in productive activities in the U.S. was to pay the tax, and they were obviously reluctant to do so given the high corporate tax rate. And so everybody knew we needed to change. The question was, what are we going to change to? There were two major possibilities. One was to emphasize U.S. source-based taxation, tax business income earned only in the United States, and provide an exemption for business income earned abroad. This is known as a territorial system or participation exemption system or dividend exclusion system. That was on the one hand. On the other hand, there were others who were advocating for current taxation of worldwide income of U.S. Companies. And so Congress, faced with a choice between these two very stark alternatives, chose both. An issue that I'm sure we'll discuss in some detail, but we have a very odd combination of a participation exemption for some subsidiaries, but not for all subsidiaries, and on income that is under 10% of tangible personal property abroad. So it's a very limited, I would argue, territorial system coupled with a lower rate system of taxation on worldwide income.
Can I ask you a question? Will the lower rate prevent companies from inverting? Is inversion no longer a viable strategy for companies?
I think there are lots of reasons that companies will no longer invert. There are barriers to it in the United States, which have been strengthened. It's actually an irony to me. There was a period of time when you could invert by sending a piece of paper to Bermuda. Then over a long period of time, we shut that down, we shut down the next thing, we shut down the next thing, and then you could only invert by sending real people and real assets into the UK or the Netherlands, which strikes me as worse than sending paper to Bermuda. But that's where we were. We're not going to see many inversions, although there was talk of one right after the act.
Yeah, I mean, I think the reality is over the last, and for those who don't know what an inversion is, in the purest form, it's a U.S. multinational company which is incorporated in the U.S., switching its tax domicile by putting a foreign parent, whether in Ireland or Switzerland. The UK is more popular today, and therefore not really substantively changing its operations or its management, but changing its tax domicile to reduce its tax rates. Now, inversions morphed over the years because of regulations and other reasons, and over the last really 3 to 4 years, the inversions that really were getting done were true closer to merger of equals. So a French company and a U.S. company merging and moving to the U.K. in close to a 50-50 deal, as opposed to just a pure tax trade. But because of a combination of factors, especially a series of regulations that were written primarily under the Obama administration, those largely got shut down. This tax bill, I think, reduces but doesn't eliminate the benefits of moving offshore.
No, I think if you're going to have a merger of equals, as you described, you'd want the foreign parent on top.
That's exactly right. Yep.
So that there's still incentives for a U.S. company to be acquired by a foreign parent.
Yeah.
Those haven't been eliminated.
We did have one announced about a week or so ago. Dana Corporation is structuring an inversion with, the name escapes me, but they're acquiring a new UK company is going to be formed called Dana PLC, which will acquire all the stock of Dana Inc. and a division of a UK company. And what's interesting to me is the CEO on the conference call said that the benefits of inverting were still dramatic. They felt that the inversion would be worth $600 or $700 million in tax savings compared to doing the deal without an inversion, which strikes me as unlikely, but that's what he was touting.
And the worldwide tax rate is higher, of course, if it's inverted. So it's not clear to me that
on the theory, people
sense.
used to invert to position themselves to shift income from the U.S.
Right.
to more favorable foreign environments, to position themselves to repatriate earnings without any U.S. tax cost. And now you can, as you just pointed out, the rate is competitive, with just about every other country. And there's a participation exemption system which permits, without any subterfuge or maneuvering, permits you to repatriate earnings without any U.S. tax consequences. So it struck me as unusual and unlikely that the tax benefits the guy was touting was anywhere near what he was saying they were.
Yeah, I'd be surprised by that number myself, but you never know.
Yeah.
It is worth. There are lots of issues that flow from this new hybrid system of international taxes, and we will talk about them. But among them, the question is, where should you locate your IP income? Where should you locate your IP ownership? Where do you locate your borrowing? How much borrowing do you locate in one country versus another? What do you do about transfer pricing, the incentives for transfer pricing, which is pricing among intercompany related parties have changed. And there are major concerns, I think, in the U.S. multinational community about efforts that are going on, particularly in the European community, but not just in Europe, unilateral efforts in places like Australia and India to tax U.S. profits. And so people are more concerned, I think, with double taxation of profits than they have been, which we can also talk about. The European Commission is really behaving in a very unique, unprecedented, and dramatic fashion, I would say. So the international rules are a key part of this, and it is a major transformation of a century's worth of prior law on the international side.
The other interesting thing about the international regime is what they've done is retain most of the pre-tax cut, tax reform rules
Right.
and appended on these new rules. So not only has it changed it dramatically, but it's kept all the complexity and just appended onto that additional complexity. So, tax reform was meant to have a more rational tax code and also, to some extent, a simpler tax code. The simpler piece has gone dramatically in the opposite direction, whether it's multinational corporations, pass-throughs like partnerships and S-corps. So we got an incredibly complicated regime already that has become infinitely more complicated.
The other big business change, which I'll mention, and this will affect lots of smaller businesses, but it also affects lots of large non-corporate businesses, is that because they were reducing the corporate rate, Congress was convinced, and here I think lobbying outweighed analysis, if I can put it that way, but they were convinced they needed to lower the partnership rate, even though much partnership income is now in very large entities. But I'm now confident that opponents of tax increases or supporters of tax reductions like to hide behind small businesses, and many of these large partnerships effectively use small businesses as their stalking horse. If you look at U.S. business income, about half of total income is now earned in the non-corporate sector. This is partnerships, limited liability companies, which are taxed as partnerships, and subchapter S corporations, many of which, because of the existence of private equity, sovereign wealth funds, investments by endowment, tax-exempt endowment funds and pension funds, have amassed very large amounts of capital without going to the public capital market, and therefore have been able to avoid the corporate tax. The most recent economic analysis of this income of these flow-through entities suggests that about 70% of that income flows to the top 1% of taxpayers, and yet Congress has enacted a very complicated I hate to say this, but
go ahead.
Widely applicable. I mean, I've been talking to my, I won't call him a hairstylist because I don't have that kind of hair, but my barber about this and what he should be doing to deal with it. So it does affect many small businesses. It affects the way in which individuals actually are organized. And it is a 20%, think of it as a 20% reduction in the tax rate that applies to the eligible business income. And that reduces the top rate from 37% to 29.6%. It reduces the bottom rate from 10% to 8%. And it complicates, I think, rather dramatically the question of whether you want to organize as a corporation or whether you want to organize as a partnership, which is something that we can talk about. There are a number of businesses that, if you have income, if you're a married couple below $315,000, none of this matters. But if you're above that level, if you're significantly above that level, many professions are exempt from this. They're not eligible for this, so that doctors, lawyers, accountants,
Investment bankers.
entertainers, investment bankers, although there's an interesting question about, quote, small banks that I'm puzzling over. Investment bankers, they're out. Athletes and entertainers are out if you're in the performing arts. But barbers are in, tailors are in.
And of course, architects and engineers.
Architects and engineers they were out in the House bill, and they managed to get themselves back in by the time the final bill was enacted. If you're above this threshold, then your eligibility for this turns on your amount of wages and your amount of tangible property, tangible personal property. And so this is an interesting provision because it creates an incentive for my barber, for example, to have all of the hairstylists and everybody else. He's got a spa. He's got a good operation going. I think he's above the threshold to have all of his hairstylists as employees. But of course, all of the hairstylists would like to be independent contractors so that they would qualify for the 20% tax cut. And so this creates a huge problem. And then, just as a footnote, the other thing the bill did here was it disallows deductions for business expenses of employees if they're not reimbursed by your employer. But if you're an independent contractor, you get to deduct these expenses. And so I think we're going to see two things on this front. One is there are going to be a lot more independent contractors. The number of independent contractor returns has been going up. People, if you ask them, are you an employee or are you an independent contractor in a census question, which is a common census question, that number has stayed flat. People say, oh, I'm an employee, but then they find themselves having to file a Schedule C as independent contractors. It's gone up from about 13% of returns to 16%, which is a pretty big jump in the last few years. And there are just all sorts of odd things.